David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm joined by David Guttery, president of Keystone Financial Group here in Trussville, for his thoughts on why avoiding the emotional roller coaster is key to the success of your financial plan. David, there is so much emotion these days. Throughout the year, we've talked about the possibility of being in a recession and strategies for investing consistently through a recession. I believe that today you're going to discuss why it is critically important to avoid the emotional roller coaster if financial planning efforts are to be successful.
That's correct. As I've mentioned in previous videos, if I could offer one universal piece of advice to any of your viewers that remain in pursuit of their long-term financial planning objectives, it would simply be to not quit during times such as these. There seems to be a mindset at times that discontinuing investments into qualified plans or simply letting those deferrals accumulate in cash makes for the better option when we have economic uncertainty and market volatility. I strongly disagree with this view. What you do today could have a measurable impact on where you arrive tomorrow. That doesn't mean that the composition of your portfolio doesn't change. Of course it will change as market factors change and economic conditions change. To illustrate this point, I'm going to walk through this graphic in three parts as we describe the emotional roller coaster that we must avoid as we try to bring long-term planning objectives to fruition.
Well, this sounds like it will be a very interesting topic. So, David, let's begin with the first part of the graphic that you described. What emotional states are you helping clients to navigate during this part of the cycle?
For those of your viewers who have seen our previous videos, they will recognize this graphic as being very similar to a description of the economic cycle that I have described before. One of the main roles that I have as a financial advisor is to remain dispassionately focused on the long-term objectives that we have codified within our plans and in the process help clients avoid this emotional roller coaster. So let's take a look at this graphic again. Let's start on the far left. To set the stage, the economy is growing. Markets are faring well. And each month when you receive your statement, you're excited by the growth of your investments. Now, this can cause you to metaphorically throw caution to the wind and begin to assume risks that may be outside of the boundaries that we have codified within the planning objectives. After all, risk is always easy to assume when everything's going up, correct? The irony, though, is that while you feel exuberant about your portfolio, we are nearing the point of maximum risk. During this part of the cycle, one of my main tasks is keeping clients oriented on the path that we have implemented for the achievement of the long-term goals. We can inadvertently undermine that effort if we're not mindful of risks and guardrails during periods of time such as this.
David, that makes a lot of sense. Okay, so describe to us what happens in the second phase of this graphic when we have passed a point of maximum risk.
Sure. I believe that we are experiencing this part of the cycle at the present time. To set the stage, we have begun to recognize red flags with regard to the economy and the markets. Markets have begun to reprice risk in recognition of those red flags. We begin to see negative results to a degree, but we're still exuberantly confident in the past performance of the portfolio. So let's take a look at this graphic again to describe these stages that often occur next. First, we contend with the denial that the market and economic environments are changing in a material way. Ultimately, that gives way to fear and the thought of, well, I hope I was right in that assessment. After more losses accumulate, we begin to desperately look for immediate solutions to stop the bleeding. That leads to trading that realizes losses that had previously existed on paper. As the devaluation continues, we hit panic mode and ultimately what we call capitulation. This is when an investor is just emotionally exhausted and liquidates everything to cash. because they have remained with an investment strategy from which they should have exited a long time ago. Ironically, this is often the point in the cycle when we are very close to maximum opportunity, or the bottom of a cycle in the market. I've said this on many occasions and I will reiterate it again today. Absolutely no one, regardless of how well qualified, can accurately predict when the market bottom may occur. For this reason, you must constantly assess areas of market exposure and limits of risk relative to the goals that are being pursued.
Well, so far, I believe we can all relate to the description of the first two phases of the emotional economic cycle. So tell us about the emotional states that occur following the point when markets may have established a new low point.
This is where I believe the greatest amount of risk is present as it pertains to achieving long-term goals. So again, to set the stage, we have watched our investments outperform our expectations. And then following denial, fear, and ultimately the capitulation that follows, we've locked in losses and just in advance of the point of maximum opportunity. So let's take one more look at this graphic as we describe the final phase. Now we begin to see markets moving on fundamental points of data. Markets begin to rise, and gradually, such things as earnings, revenue, and macroeconomic metrics once again seem to be driving market movements. You watch this from the sidelines, still sitting in cash, brooding over the large losses that you recently realized during the capitulation phase. As the markets continue to climb, this gives way to apathy. The markets continue to climb, and then we have a state of indifference. This is where investors think to themselves, well, if I get back in the market now, it'll just retest the previous lows and I'll be right back to where I was anyway. As the market continues to climb, investors reluctantly think to themselves, oh my goodness, the market is leaving me behind, so I'll put 25% of the cash back into the market. And then as the climb continues and markets recover, optimism begins to take hold and another 25% is allocated back into the market. Ultimately, investors begin to feel comfortable that the worst is behind us, and then they plow the rest of the cash into previously invested positions. The problem is that at this point, we're nearing the point of maximum risk again, where the cycle can repeat itself.
Well, David, that is a very good depiction of states of emotion during fluctuating periods of time. Can you illustrate to our viewers why it is important to maintain consistency through such periods of time for the achievement of long-term goals?
Absolutely. I took an actual client's plan and turned it into a sample case for this video. I'm only going to show you one slide from the client's plan, and this is the Monte Carlo stress test of our assumptions. These clients were very young, in their early 30s, and we recently evaluated their plan for retirement and implemented a strategy for the achievement of these goals. This graphic depicts 4 confidence intervals, and it reveals that this strategy has a very strong chance of producing the results for which we're planning. I made one change to the assumption reflected in this plan. I assumed that rather than a consistent investment strategy, that this couple would discontinue making contributions to their qualified plans for the next 2 years in response to current market and economic volatility. Look at the impact that missing only 2 years of investment strategy early in life has on the chances of success for the achievement of the long-term goal. With the first version, 3 of the 4 confidence intervals were significantly above what I call the red line. In the second version, 3 of the 4 confidence intervals not only touched the red line, but early enough where moving in with future children could be a possibility. So in conclusion, regardless of the period of time or the state of the economy, the achievement of long-term goals is predicate on the consistency with which you meet the implementation of the strategy. The composition of the investment accounts will change to reflect current periods of time, but the approach, the dedication, and the commitment to the strategy should be unwavering. Even missing a few years with the thought of letting a volatile period of time pass you by can have a detrimental impact 40 years down the road on the potential success of long-term plans.
Well, David, thank you so much for this information as always. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.